The blockade of the Strait of Hormuz is now rippling through global shipping markets, sharply driving up the cost and also disrupting the trade flows. Shipping lines are avoiding the Gulf due to the high rising security risk, with some vessels in fact staying idle, while others are taking much longer alternative routes. And this has led to a clear capacity crunch across segments. Now, Hapag-Lloyd estimates that the war is now adding $40 to $50 million in terms of weekly costs, driven by higher fuel prices, insurance and logistical disruptions. With nearly about 20% of the global oil and LNG flowing typically through the Strait of Hormuz, even limited disruption is going to significantly tighten the global shipping supplies. The impact is most visible in freight rates, which have surged across oil, gas and container shipping. Earnings for Suezmax crude tankers have more than tripled, while LNG carrier rates have also tripled to about $90,000 per day. Shipping crude from the Gulf to China has spiked even as actual cargo movements remain limited. Container shipping is also under pressure. Spot rates for a 40-foot container have now risen 20 to 25%, while war-linked surcharges on key routes have surged by nearly about 20%. At the same time, bunker fuel prices have nearly doubled, further pushing up operating costs. And beyond fuel and freight, insurance premiums have surged sharply due to the escalating war risks. And ships that transit through the region are now paying anywhere from 3.5 to about 10% of the vessel value as insurance, adding millions to each voyage. And the impact is already being felt in India, where exporters are facing some freight rate hikes of up to 40%. Higher shipping and fuel costs are also feeding into domestic prices, increasing the cost of goods and household fuel.